Good morning, everyone. My name is Rano Ghosh. I am an international tax partner with BPM. I want to welcome you. We're to this presentation on the DAC7 and one-stop shop. This presentation is a presentation in conjunction, a collaboration between Azets Ireland and BPM. And our goal here is to introduce new North American clients to these the various new rules that have been introduced under the DAC7 rules and address any other questions that may come up.
So what we'll look at first is who does DAC7 apply to. So a reportable entity under DAC7 is defined as any operator of a platform who allows the seller to be connected with other users for relevant activities. And relevant activities are defined as any of the following which is carried out for consideration. So either the rental of a property, so be it a sort of Airbnb or a hotel, a personal service, which we'll go into a bit more detail later, the sale of goods, and then the rental of any mode of transport. So a platform operator is any software which allows users and sellers to be connected. So typically it would be websites, mobile apps, as well as any sort of arrangement that allows for the collection and payment of consideration in respect of a relevant activity. A platform operator is not just any software that exclusively processes payments, or it's used for listing or advertising of relevant activities where the actual transaction takes place outside of the platform. An excluded platform provider is one that does not have any reportable sellers in the EU, and it also makes an annual declaration to revenue each year. If a platform provider is not resident in an EU member state, it may still have a registration obligation if one of the following is true. It is incorporated in a member state, it has its place of management in a member state, it has a permanent establishment for corporate tax purposes in a member state, and it is not qualified, or it is not a qualified non-union platform operator, which we'll touch on shortly. And then finally, if it facilitates the carrying out of relevant activity by reportable sellers or the rental of a premises in the EU, and it is not a QNU. So for that last one, even if it is not established in the EU at all, or does not have any of the three sort of tax residence, place of management, or PE, it could still possibly need to register for DAC7. Then on the right, so we go into sort of our points that probably need a bit more consideration. We'll start with consideration, which means any sort of compensation which is paid to a seller, which can be reasonably known or is quantifiable by a platform operator. So that means if a platform operator simply is used to list the details of a seller, but then a prospective customer takes those details off a website and then outside of the platform engages with the seller and they agree a sale, then a platform operator could not reasonably know that has transpired, so they would not get caught under DAC7. And then a personal service is any service which is provided by a seller, so personally, so to any individual or a group of individuals. So we have a few examples: transportation, delivery, manual labor, but really a personal service is just any service that is provided, I suppose, with the customer in mind. So if it's simply just buying a software off a website, that is not tailored towards each customer, so that's not a personal service. Whereas if for example, if we take the website Cameo, for example, if someone was to pay money and a celebrity or a podcaster, any sort of known person makes a video tailored specifically for that person, that is a personal service, and that would fall within. So if we can go next slide. And then who are qualified non-union platform operators? So a platform where all of the facilitated activities are relevant activities which are covered by what is called an automatic exchange pursuant to effective qualifying competent agreement, which is quite a bit of a mouthful, and it is relevant in a qualified non-union jurisdiction, or where it is not resident in a QNU, but it is incorporated under the laws of the QNU, or has its place of management in the QNU. And this is a clause that is included in quite a few sort of the DACs that have come out within the EU. So recently, the DAC 8 provisions for crypto came out and had the exact same clause. So really what this says is if a non-union territory or jurisdiction has rules that are similar to DAC 7, and those rules are recognised by the EU, then there will not be a requirement to duplicate the reporting on both this on DAC 7 and on this sort of QNU platform. But again, this is more just something that's in the legislation. We're not aware of any jurisdiction that currently meets these requirements. So for now, it's really more just in theory, but potentially down the line, it could be something that applies. Next slide, please. Then what must be reported? So a platform operator is required to collect information on its reportable sellers. A reportable seller is any seller which is registered on a platform and carries out the relevant activity which we spoke about before. And then any seller who is on the platform and is resident in the state, in a member state, or has rented out a movable property in the member state will be a relevant seller, provided that they are not an excluded seller. An excluded seller is a government or a state body, a listed entity such as a PLC or any entity that's listed on a stock exchange. And then there is sort of an out for property rental companies for hotel operators where they have rented out their property over 2,000 times in a single year. So for example, if you take booking.com, which would be an operator, if a hotel had only been let out less than 2,000 times in a year, they would not be an excluded seller, and booking.com would have a requirement to report them on a DAC 7 return. And then finally, there is a de minimis reporting for sellers who have both less than 30 sales on the platform, and those 30 sales amount to less than 2,000 in a given year. So if you have 31 or more sales, or over 2,000 in sales, you will not be an excluded seller, and a platform will need to provide your details to the relevant revenue. And then on the right, I'll just briefly go through the list of information required. So it's some basic company information, details of any VAT numbers they have in the EU, where they have multiple VAT numbers. Each one needs to be listed, and then where they're involved in the different relevant activities. So the sale of personal services, the renting of movable property, and sale of goods. For each of them, if a seller was engaged in multiple relevant activities, they would have to provide details of what consideration and what tax has been paid on each activity. Next slide, please. And then where and when. So where a platform is registered or is established in the EU, so whether it is either based in the EU member state, it's tax resident in a member state, it's incorporated in a member state, has its place of management, or a permanent establishment, it is required to register in that member state. In some scenarios, you will have platforms that could have branches across the EU. In that case, they get to pick one designated state to register for DAC 7. Where a platform operator does not have any establishment within the EU, they can pick and choose what EU member state they wish to register for DAC 7. And then when must they be made? So DAC 7 was introduced from the 1st of January last year. Return for the previous year needs to be filed by the 31st of January. So the first return is due by the 31st of January this year, which is just over 2 weeks away. So, really, if any of you feel that you may get caught by this, you really should reach out after the call, as associate time is of the essence. So to start, what is VAT? So value-added tax is a tax on transactions. It's a tax on the supply of goods and services. It also arises where goods are imported into the EU from outside the EU. So as opposed to income tax and corporation tax, it is taxable on the turnover of a entity rather than their profits. So you could have an entity that is in a loss position but still has to pay tax, still has to pay VAT. Most countries have the equivalent of VAT. So VAT is generally an EU tax, but we have goods and services tax or sales and use tax in other territories outside the EU. Businesses effectively act as unpaid tax collectors, so they pay VAT or they charge VAT on their sales, and then at the end of the period they report it to their local revenue. In effect, it is a tax on the end consumer. Any business that is charged VAT on its purchases should receive a deduction. So it's really just the end customer who is not engaged in a business that effectively pays the tax. Across the EU, VAT can vary from 17 to 27%. The average rate is bang on 21%. In Ireland, it's 23%. So the key terms which we will chat through today are business to business. So that is our starting as business to business or B2B. So that is the transaction between one business and another, for example, a wholesaler and a retailer. Business to consumer, transaction between a business and a non-taxable person or a consumer, and then as example, a retailer and an individual. Place of supply is a term used to determine where VAT is due on a transaction. So it's generally the member state where VAT is payable or accountable. And then finally, digital services. So these are services that are both delivered over the internet and without or with a minimal amount of human intervention.
This is Frank. Just a quick addition to this slide, because that's the obvious question is, of course, how do I know whether I deal with a consumer or a business? And as you explained, the consequences are significant. And that's where we go back to the question always, when you do terms and conditions, when you enter into a transaction with your clients, the first question you should ask that client is, what's your VAT number or what's your GST number? Because the rules are very similar in all those places, Mexico, Canada, whatever. And if you get a VAT number, you kind of can assume that this is a business to business. If it's not, because there's no VAT number, typically you're going to have to assume that it's a B2C because there is no VAT number, which is typically a sign of a consumer. So that's a very important start for any kind of relationship, that you have to know who you're dealing with before you even get to the next phase, so to speak.
Yeah, exactly. Yeah, thanks for your input, Frank. So as Frank said, once you determine that a customer is a consumer and the B2C rules apply, then we jump into just one-stop shop, and formerly mini one-stop shop. So from the 1st of January 2015, new place supply rules were introduced for certain B2C supplies of services, so telecommunication, broadcasting, and e-services/digital services. And these rules meant that a supplier was required to account for VAT wherever a non-taxable EU-based consumer resided, and this applied to both EU and non-EU businesses. So there was potentially VAT registration obligations in multiple EU member states. So the mini one-stop shop was simultaneously introduced to allow suppliers to report and pay any VAT arising on TBE, telecommunication, broadcasting, e-services supplies on a single consolidated return. If you were established outside of the EU, you could opt to register for MOS in any EU member state. Then on the 1st of July 2021, MOS was extended into the one-stop shop OSS. So in addition to the above services, OSS also covers any distance sales of goods from one EU member state to another. A distance sale is typically goods sold by a business to a consumer that sort of crosses an EU from one EU territory to another. And then it also covered any sort of B2C service supplied to customers residing in the EU that were subject to VAT in the EU. Then OSS is just a simplification, to cut down on administrative administration. So if you didn't utilize it, you would be registered. Would be required to register for VAT in multiple EU member states. So if you had a customer in Ireland, France, Germany, you would need to register in each of those member states, unless you utilized MOS or OSS to just file a single return. And it's important to note that OSS can only be used for future supplies. So once you are registered, if you breach the thresholds and had relevant sales in from say 1 July 2021, you would be required to go back and potentially register in multiple EU member states to fix the issue. You can't use it to repair the past. So in OSS, we have two schemes, so the union scheme and the non-union scheme. So the union scheme is used by EU-based suppliers to report all sales that fall within OSS. So it can be used for supplies of B2C services or for intra-EU distance sales. It can also be used by a non-EU established supplier only where they have distance sales. If a non-EU established supplier has B2C services to serve to customers in the EU, they must register for the non-union scheme. So potentially, if you have a non-EU supplier engage in both goods and services to EU consumers, there would be an obligation to register for both the union and non-union scheme. And then finally, the union scheme has a threshold of €10,000. So if it is below that, then there isn't a requirement to account for VAT in the member state of the consumer. Instead, it can be done in the member state where the supplier is established. But then we move on to non-union scheme, which, as I said, is just for B2C services supplied by non-EU established suppliers to EU consumers. Then there is no threshold. So technically, if you make €1 of sales to a customer in Ireland, for example, you would be required to register for either VAT or OSS to report the VAT due on that sale.